Good morning, everyone. We welcome you to another edition of Zen Tax Talks. This has been a regular feature, and then after the budget, we wanted to have a thorough look into the various aspects of the budget. So the budget is a usual expectation, but I every time used to say after the introduction of the GST, the inquisitiveness for the budget has reduced a little bit, I can say, because prior to that, there will be changes in the central excise rates. So that will come into effect immediately. That will come into effect immediately from the night or from the day of the budget. So as soon as the budget is going to come, the central excise officers will say, do not issue any invoice on that day, because there will be some changes. And if there is going to be changes, then if there is a upward revision, and then if you are going to remove it, then they will be losing that 1 day revenue, or it will be at a reduced rate. So we used to send the stock statements and various other details to the department at the time of budget. But now all those things have gone. There is no element of surprise in the rates of tax as far as the goods and services are concerned, because the rates of tax or changes in the rates of tax has to be notified only. So it has to be passed by the GST Council, and then after that only the various changes will come into force. So there is no any surprise elements in the budget as far as the indirect taxes are concerned. And also sorry, there was a small interruption here due to the issue of the camera and then mic settings. Okay, so there is no such a big surprise elements coming, because all the changes are made, and then after that only these things will come into effect. So the changes are made as soon as the central GST Council comes into force, or as after the GST Council meeting, various notifications are issued, because the council, the GST Council being the highest powerful authority, only it can take the decision. It consists of the finance minister and also finance ministers of the various states. They cannot take the finance minister, however powerful, cannot take the independent decision, because it has to be a consensus among all the states at the GST Council. Then only a notification can be given, or law can be amended, or any changes in the rules can be made. So GST Council being the highest and then powerful authority for the implementation of GST, the relevance of the budget has waned a little bit, I would say, after the coming into the effect of the GST. So this is a fact that we have to accept it. And also there was a major changes made in GST 2.0. So because of that also many changes have taken place long back itself. But in spite of that, there are changes. I used to say, I want to see a budget where they say, except because the rate of tax for income tax has to be notified in the budget. Other than that, there should not be any changes. It is not like that. Even the Income Tax Act 2025 was recently introduced, and in that also there are many changes have been proposed. So the change being the inevitable, and then every budget there are changes, but these are done in the finance bill. So finance bill. So that is why the reading of the finance bill is a paramount importance. What the finance minister reads in the budget speech is an overall view, but the technical details and then in-depth analysis is required when we are going into the finance bill only. So this is a basics of the budget, and then let me go into the GST amendments. I will be dealing only with the GST amendments. Arvind will be dealing with the direct tax amendments. So every speech we used to put this one, கற்றது கைமண்ணளவு கல்லாதது உலகளவு. That is what we have read is only to the sand that we can hold in our hand, but what we have not learned is to the extent of the world, size of the world. So with this small remark, I can give you the what are the amendments that have taken place in the GST law with the small amount of what I have learned from this budget 2026, the amendments that have been carried out. First of all, as I mentioned, when the GST amendments will become effective, when the GST at the introduction of the Finance Bill 2026, will it become effective, or when it is passed by the Lok Sabha, or when it is signed by the President? So these are all the stages in which the finance bill goes through, and when the amendments will become effective. So that is a very, very crucial, because as I mentioned earlier, during the central excise era, the amendments will become effective as soon as the budget speech is over, or as soon as the notification or change rates are published. That day itself it will become effective. But in the GST era, this is not so. Why this is not so? Though we call it as a GST, as you will be aware of the fact, every state has got its own law. Suppose if you buy an item locally, you will see in the bill, there will be CGST and then SGST. So for that portion of SGST, every state has to pass a similar law, so that only there will be a uniformity in the CGST Act and the SGST Act. Without this uniformity, then the Act cannot be implemented. Suppose there is a change in rate notification that is being, suppose an item from 18% to 5% has been notified only in the CGST, and then SGST there is no corresponding notification, then it cannot be properly implemented. So any amendment that has taken place in the CGST Act, the corresponding amendments have to be made in the respective state GST Acts also. So every state has to amend its own GST law, so that both CGST and then SGST wordings are on the same line. Without that, it cannot be implemented. So that only now the GST amendments will come into force after it is being notified. So they will give you the amendments, what are the amendments proposed in the finance bill, and then it becomes Finance Act. Immediately it will not come into force, because after that every state has to change or amend its own GST law. Tamil Nadu Tamil Nadu Goods and Services Tax Act has to be amended in line with the CGST amendments. So after these amendments only, the date from which the provisions will come in will be notified. So the amendments will become implementable or implemented only by issuing the notification. So this is very, very crucial. So after that, the notification date has to be taken into consideration, whether when the provisions will come into force. First, I will be dealing with the IGST amendment, Integrated Goods and Services Tax Amendment. There is only one amendment, but this amendment is very, very crucial. To understand this amendment or to understand the implications, I shall go through the amendment from the basics. Though this is the only thing, this section has been omitted. This is a thing, but it has got a very, very wider implication, I would say, wider implication. So I thought I shall deal with this implication first. Then I will go to the other amendments that are happening or that have been proposed in the CGST Act. See, every country wants to export the goods and services. Every country wants their goods to be competitive in the world market because the exports only bring in the invaluable foreign currency. So in order to attract the foreign currency, every state or every country has got a principle: export the goods, but do not export the taxes. Do not export the taxes. This is the basics of the exports. Every country exempts the taxation of the exported goods or services. Exported goods or services. India is not an exemption to this policy. So in the earlier regime also, be it may be the central excise or VAT, or even prior to that General Sales Tax Act or service tax, we had the exemption. We had the exemption for the export transaction. So this is a universal from the long back. Exports are exempted from taxes. So this is the important criteria we have to bear in mind. But here, what I would say is, merely the amount I have received in foreign currency, will it become an export transaction? So that is a crucial question. I have received the amount in foreign currency. Because I have received the amount, I should be exempt from GST. See, this is a general understanding. See, because every country wants a foreign currency, I have brought in foreign currency, so you exempt this transaction. I shall not pay this GST on this amount. Can we say? We cannot say like that. Because the export, what constitutes export? There is a definition. Definition for export of goods and then definition for export of services. Only the export of goods or export of services that falls within this definition will enjoy the benefit of the exemption provided in the statute. In the statute, they will enjoy it. Otherwise, they cannot get it. What do you mean by export of goods? Export of goods. See, the export of goods being physically or it can be easily identified, the export provisions are, the definition is very, very simple. Well, there is the export of goods definition, you can find it in IGST Act. Because integrated goods and service tax only deals with the export. The definition for export of goods is contained in IGST Act only. How it has been defined? I have given the definition in this portion. Export of goods with its grammatical variation and then cognate expression means taking goods out of India to a place outside India. So this is very, very important. So goods should move out of India to qualify as exports. This condition is very, very important. Okay, the goods should move out of India. See, I shall give you an example. There is a company, okay, ABC Limited, it is that. ABC Limited, it is an Indian company. Okay, XYZ is a foreign subsidiary. This XYZ, ABC is situated in Coimbatore. This foreign subsidiary is situated in Hyderabad. So, you are sending the goods from Coimbatore to Hyderabad. That foreign currency is received from the parent company situated in USA. Goods are moved within India, but you are getting the amount in a foreign currency. Can you call it as an export because amount has been received in foreign currency? No, you cannot do like that. So, because the goods have not moved out of India, this is very, very crucial. And also recently, the department of officials are raising the demands for the molds. Okay, so this molds is a very, very important component or important part that is used for the manufacture of the various components, molds. So this is an area that creates problems. See, the automobile industry, see, they have got the molds and dies are kept at the premises. But automobile manufacturing, the component manufacturer gets the cost or the price for this molds and dies from the foreign company. Using that molds, the molds will be the property of the foreign company. So, but the components are used with the help of this molds and dies only. For this, they receive the amount in the foreign currency, but the molds and dies does not move out of India. With this use of the molds and dies only, the automobile components are manufactured. The department is raising GST issues on this area. So anyone who has received any amount in foreign currency for these molds and dies have to keep in this aspect very, very carefully. Because after in future, you may be visited with the audit official or inspection. At the time, they raise the issue with the interest and penalty. So whenever the goods are not moving out of India, then it is not an export of goods as per the definition. See, the definition means taking goods out of India. Here, this automobile industry, this is a very, very common problem. The dies and molds do not move out of India, though the amount is received in foreign currency. So you have to pay GST. In that situation, it is a local sale, then it will attract the both CGST and then SGST. For that, you have to make the payment. Whether now the plea that is raised by some of the component manufacturers, sir, how can you charge to the foreign buyer? He will say it is a local law, so I will not pay that amount. Yes, that is the amount they will raise, but you have to pay. That is the only issue. So you have to pay from your own pocket. So this is a very, very important because this will affect your cash flow. Because sometimes these molds and dies are invoiced for more than 1 crore or 2 crores, but you are saddened with the liability for this amount. So export merely because amount is received in foreign currency does not constitute an export of goods. The goods should move out of India. So this is very, very important. Export of service also, just like export of goods, there is a definition for export of service. The export of service should satisfy all the conditions satisfied or specified in this definition. This is very, very crucial. Only when there is a satisfaction of all the conditions, it will be considered as export of service. Otherwise, you will be liable for GST. So, how the export of service has been defined? How the export of service has been defined? This is a very, very somewhat lengthy part, I would say. There are five stipulations what constitute an export of service. First one is the supplier of service is located in India. So naturally, export means he should be in India. The recipient should be situated outside India. The third is very, very crucial. The place of supply is outside India. So this is very, very crucial. Place of supply should be outside India. Then the usual consider the amount should be received in foreign convertible or Indian rupees wherever it is permitted by RBI. Amount received in local currency should be permitted by RBI. Then only it will be considered as export of service. So for permitted items, you can get it in Indian currency. Still, you can get the benefit of export of service. Then the supplier and the recipient are not merely, this is somewhat technical. So these four we shall deal. All these are defined terms. Again, when there is a definition, you have to go by the definition means. Because if you see that export of services means, so this is a exclusive definition. So only the transaction that satisfy these conditions will come under the definition of export of services. definition. There are definitions for location of the recipient of services and then location of supplier of services. These are a definition. I'm not going into that definition of service, location of the recipient or location of the supplier. Place of supply. Place of supply is also a well-defined legal concept. Well-defined legal concept. You cannot shift the place of supply according to your whims and fancies. The same thing applies to the department also. The department has to go by the place of supply as per section 13 only. It cannot fix its own goalpost. Wherever I say it is the place of supply, it has to be within the framework of law as per section 13 of the IGST Act. So, section 13 applies when either the location of the supplier or the location of the recipient is outside India. So, supplier is outside India or recipient is outside India. See, whenever the location of the supplier is outside India, then naturally the recipient will be within India. So, that will constitute import or service. So, location of the recipient is outside India, location of the supplier is in India, then it will constitute export. So, this is a basic. So, the place of supply to come within the definition of export of service, we have seen the location of the recipient should be there. The place of supply should be outside India. So, the place of supply should be outside India. So, this is very, very crucial. With this place of supply only, the amendment has come. So, to go into that amendment only, I am giving all these details because the place of supply is very, very crucial to determine whether there is an export of service or import of service. So, the subsection 2 is a general rule. So, it says the place of supply is the location of the recipient of services. So, the place of supply is the location. See, location of the recipient of service is a defined term, but I'm not going to that. The place of supply is the location of the recipient of service. This is a general rule, but this is subject to subsections 3 to subsection 13. So, these sections may be going against this general rule. So, the location of the recipient may be outside India. Still, you have to pay for GST. So, this is the, if it falls under some other clauses which are specific in nature. See, this is a general provision, others are specific in this nature. To illustrate, I'm not going into all the subsection from 3 to 13. To illustrate, I'm taking about the immovable property services. Immovable property services as per subsection 4. See, in immovable property service, the place of supply is the place where the immovable property is located. So, that is the place of supply. So, I have given an example. LMW Limited has got its own office space and then it has been left out for an office purpose, not for business purpose. They are having an office for Microsoft Corporation, USA. And then this LMW Limited is getting $1 lakh per month in foreign currency. They say, I have received the amount in foreign currency. That company, the recipient of service is also located outside India. So, this is an export of service. As per the subsection 2, they cannot say. Because subsection 4 is a specific provision which is applicable to immovable property. According to this specific provision, the place of supply is the place where the immovable property is located. So, irrespective of the fact, amount is received from a recipient located outside India and then amount is received in foreign currency. One more condition, the place of supply should be outside India is not fulfilled. As per the export of service rules. Renting of the property is a service only. So, this condition is not fulfilled. So, this will not be considered as export of service. So, they have to pay, LMW has to pay. See, there is an imaginary problem, nothing connected with LMW or anything. Since this is a company located in Coimbatore, everyone will be aware of this. So that I am using that name, nothing else. So they have to pay CGST plus SGST. So this is how the place of supply provision works. Now we have to come to the intermediary services. Who is an intermediary? Who is an intermediary? See, intermediary means there is a definition in IGST Act. Intermediary means a broker agent who arranges, facilitates supply of goods or services between both. So he is not rendering service on his own account, or he is not supplying goods on his own account. He connects two persons. He connects two persons, and then for connecting these two persons, he gets a commission. He gets a commission. He is an intermediary. So in colloquial language, we can say he is a commission agent. Commission agent, or in the local terms, he is a broker. So this is a word that is used in the definition also. So a person who is connecting the two persons, and then for connecting or for this purpose, he is getting money. He is a intermediate services. What is the change that has happened? So this 13 subsection 8 clause B, the intermediary services, the location of the supplier of services. See, location of the services of the supplier of service is the place of supply in case of intermediary services. This exactly goes against the general provisions contained in subsection 2. Subsection 2 says the location of the recipient is the place of supply. Here it exactly goes against that. The location of the supplier of service is the place of supply. So what they have done, So what is the problem in this earlier provision? What is the earlier provision? See, A is located in India. What is the anomaly that they want to separate? So A is located in Coimbatore. He asked ABC in Australia to supply butter to XYZ hotels in Dubai. See, A has got good contacts. So he has got the contacts with XYZ hotels. They want good butter. So it asks Mr. A asked the ABC Limited in Australia to supply butter to XYZ hotels in Dubai. He acts as an intermediary. He gets a commission. Australia person say till now it is liable for GST because A is located in India. So the place of supply. So the place of supply is the location of the supplier. So it is not the recipient, since it be a location of the supplier. So it will be considered as a local, and then he has to pay GST on that. He cannot collect it, but he has to pay from his own pocket. So this is a very, very important aspect. The goods doesn't come, goods goes outside, but his services, because he is in India, he has to pay for these services. What is the amendment proposed? So the amendment proposed is they have omitted the intermediary services in section 13 subsection 8. So intermediary services, again it will go back to the general provision. The location of the recipient. So the location of the recipient will become the place of supply for intermediary services. So any person who are rendering intermediary services located in India, he is getting the amount from a foreign recipient, henceforth will not be liable for GST. So it will not be liable for GST. So when this amendment will come into force, see, they have not mentioned anything about this in the finance bill. So, but still a notification has to come. This may be something technical or typographical error. So omission for this aspect, in my opinion. So they will be giving a notification from that date. It will be coming into force. So this is a beneficial provision for the persons who are getting the commission from abroad. They need not pay GST. Is it the end of the matter? Yes, this is a welcome measure. Can you relax like that? No, you cannot do that. There will be other effects. What is the other effects? We have to go into the definition of import or service. supplier of import or service, the supplier is located outside India. Recipient of service is located in India. The place of supply of service is in India. So place of supply is service in India. So now, because of the omission of the intermediary from 13 subsection 8, location of the recipient become the place of supply. So place of supply. Due to this will, for import of services, the person who is importing services has to pay GST on reverse charge basis. Whenever goods are imported, you pay IGST and customs duty. Similarly, for import of service, you have to pay GST on reverse charge basis. So anyone paying to a foreign commission agent, see that person will be sitting in London. He is looking into the booking sales for you in London. On the basis of the sales booked, he is getting 1% as commission. You send that amount. For that, you have to pay the tax on reverse charge basis. You have to pay the tax. This is very, very important, because simply because there is a omission, will it have any impact? The person who are sitting in Tirupur and then garment units, they are exporting the goods. They have got various commission or brokerage areas or selling agents situated abroad. So they make commission to them. So they have to pay GST on reverse charge. Yes, but they can take the ITC. If the ITC is getting accumulated for the purpose of export, they can get the refund. Everything is possible. But first, they have to ensure that the reverse charge mechanism payment is made for the commission paid to the foreign commission agents. This aspect has to be kept in mind. Now, this is the only amendment so far I have dealt with regard to the omission of intermediary in the IGST Act. So this will have impact for the person who are availing the services abroad. This is the what I wanted to stress it. Now, post-sale discount. So post-sale discount is a biggest issue in the GST era. Discount. Whenever a person is giving a discount, should he charge GST on that? Then whether a financial credit note can be given without GST, and the recipient, should he reverse the ITC on these items? These are all the various issues that are discussed in the post-GST era. What is the post-sale discount? As the name implies, it is a discount given after the supply has been made. It is after the supply has been given. So this is a commercial decision. So whenever to increase the sales, the companies used to give a discount. It may not be companies, even for some of the partnership firms, anyone or a proprietor, in order to increase the sales, they will say, suppose you are taking the goods for a certain amount, say during the financial year, you are taking the goods for 1 crore. I will be giving an additional discount of 2%. So this is a commercial decision taken by each and every company to augment its sales. The GST implications were very, very high. GST implications are very, very high. So the legal position with regard to the post-sale supply, till now, it was contained in section 15. Section 15 deals with value of taxable supply. What is the value of the taxable supply? When the buyer and then seller are not related, then the transaction value is the value of the supply. Then what are the items to be added, or what are the items to be reduced? So 15.3 deals specifically with the discount. These are not to be included in the taxable value. These can be reduced from the taxable value. So that is the important contention. Since this affects the government's revenue, government is very, very eager to curtail any malpractice or misuse of these provisions. So they have got the very stringent provisions with regard to the post-sale discount. So in that subsection 3, there is a clause A which deals with supply at the time of supply itself. See, it is getting reduced from invoice, no problem. So at the reduced value, you pay the tax. So after the supply, you are issued an invoice. After that, you give a discount. So what is the position? Since this is going to reduce the taxable value, government is very, very keen. So till now, they had specified these three conditions. for that amount to be reduced, that post-sale discount amount to be reduced from the taxable value, these three conditions have to be satisfied. There should be an agreement either at the time or before the supply. So at the time of invoice or before, there should be an agreement. Then discount should be specifically linked to the relevant invoices. Then input tax credit should be reversed by the recipient on the basis of the document. Note the word, on the basis of the document issued by the supplier. They have not mentioned what is the document till now. They have not mentioned what is the document. Why I am stressing, I will come to that later. So these are all the three conditions. These conditions were very difficult to comply with because they say discount should be linked to the specific invoices. See, take the case of Hindustan Unilever. They are manufacturing various items, but to augment one of the sale, they are going to specify the discount only for that. For example, they want to increase the sale of the RIN due to the market competition from Ariel or another goods. So for RIN alone, they are going to give a discount. So in the one invoice, they will be putting 100 items, but they have to call out what is the RIN, and then they have to relevant invoices. And also there is going to be 300 invoices and discount is going to be given after that. Then you have to list out the 300 invoices. On the basis of that, only you can give the discount. This was a major hindrance or trouble for the entire business community. So there are some relaxation in these three conditions in the Finance Bill 2026. What are the changes? What are the changes? There is no need. There is no need for the prior agreement. There is no need for the prior agreement. Then discount need not be linked to the invoice. This linkage has been removed. So at any invoice that you can give. Then there it has been mentioned on the basis of document. On the basis of the document earlier position, now they specifically given it should be on the basis of a credit note. So it should be on the basis of the credit note. So this is the amendment. So there need not be any linkages, and then invoices linkages is not required, prior agreement is not required, but the discount has to be given only through a credit note. This is very, very important aspect. The credit note, the contents of credit notes are given in the rules. So your credit note must conform to the rules to get this benefit. So since the word credit note is used, it should contain all the details as per the rules. Now the condition is he should have reversed the ITC. The recipient has to be reversed. How to ensure the recipient has reversed the ITC? You can use the IMS. Now IMS. So the recipient, now in the case of IMS, if they do not take any action, they do not accept or reject, or they do not take any action, it is deemed to be accepted. So naturally the credit note amount will be getting reduced from the recipient perspective. So as per GST advisory, they can keep the credit note pending. The recipient keep the pending for one tax period. After that, they have to accept or reject it. So if they accept it, naturally it means they have reversed it. So this is a conclusion that we can take into consideration. Can the financial commercial note credit note can be given without GST? Yes, they can give post amendment also. They can give a credit note without GST. There is a circular for that, circular number 251. So on the basis of it, they can give the credit note. Whenever financial credit note is given, should the recipient reverse it? There is an answer in that circular itself. The recipient need not reverse the credit recipient. When these provisions will come into effect, it will come into effect from the date to be issued after the finance bill is approved by the president. After the finance bill is approved by the president. Then amendments has been made with respect to credit notes. With respect to the credit notes, Section 34 deals with credit and debit notes. Credit and then debit notes. So subsection 1 of 34 specifically mentions and what are the situations in which the credit notes can be issued. So the credit notes can be issued in these three situations: tax value, taxable value, tax charged in excess, or goods supplied or returned, or goods or services are deficient. Only under these three circumstances, as of now, you can issue a credit note. Now, because Section 13 specifically mentioned for the post-sale discount, a credit note has to be issued. that has been included here. So one more situation has been included here, that post-supply discount has to be given through the credit note. So credit note has to be issued for the post-supply as per section 15(3)(b). So that has been mentioned here. Provisional refund for inverted duty structure. So inverted duty structure, you will be knowing whenever the rate of tax on outputs is lesser than the ITC rate, then naturally inverted duty structure comes into force. What do you mean by provisional refund? Provisional refund means giving the refund on an ad hoc basis without carrying out any detailed verification. So get the refund in a short span of time. So section 54 deals with the refund. In that subsection 6 deals with the provisional refund. This subsection 6 only enables the proper officer to give the refund on an ad hoc basis, that is on a provisional basis. It specifies up to 90% of the refund applied shall be given on a provisional basis. This is supported by Rule 91 also. Rule 91(2) says the provisional refund order can be made in a form called RFD 04. So payment order is RFD 05. This refund order has to be made in RFD 04. What is the time limit within which the RFD 04 has to be given? Within 7 days from the date of generation of the acknowledgement. So whenever you make the RFD 01, you will get an acknowledgement. So within 7 days, the proper officer shall issue a refund on a provisional basis order. So this is very, very important. Who are eligible till now? Till now, the person who are making a zero-rated supply is only eligible. Zero-rated supply means export of goods or services, or a person who supplies to SEZ are called zero-rated supply. Only these persons can get the refund. Now, within that, the IDS is also included. This will be applicable, or this will make the work easy for the person who are supplying goods as per section 40/2017. That is merchant exporter transaction. So as per merchant exporter transaction, you will be exporting or giving to the ultimate exporter at the 0.1%. So in that case, for the person who are undertaking merchant export transaction, the ITC will get accumulated. These persons also will be getting benefit out of this new amendment proposed. They can get the refund at the earliest by this provision. No refund amount is less than 1,000. This is very, very academic in nature. Then National Appellate Tribunal. See, when the Authority for Advance Ruling gives an unfavorable order, then you can go to the Appellate Authority for Advance Ruling. Now, still this Appellate Authority as National Appellate Tribunal is to resolve the disputes. If the two appellate authorities are giving contrary ruling, then you can go to the National Appellate Tribunal. Till the since the Appellate Tribunal has not been, National Appellate Tribunal has not been constituted, they say any other authority can be appointed as a National Appellate Tribunal. In my opinion, the Delhi Tribunal may be considered as a National Appellate Tribunal. They may be interested. This is my only guess only. Then another aspect is with regard to GST 3B. This is not with regard to the Finance Bill 2026. This is as per the advisory. This is one of the beneficial provision. If there is any IGST tax liability, see, first you have to adjust with the IGST ITC. If at all any balance, you can adjust either with SGST or CGST. That is an advisory. So you plan wherever there is a accumulation of ITC, you first set off against that IGST ITC so that there will not be accumulation in only one head. See, we can see the cases, there is accumulation only in SGST, and then it is very, very difficult. So these are all the amendments that have been coming from the Finance Bill 2026 as far as the GST portion is concerned. Now I give the webinar to the Aravind Tangam. Thank you one and all for your patient hearing.
Hi everyone, it is a pleasure to connect with each one of you at this 105th edition of Zen Tax Talk. So we had a very excellent session talking about the amendments on GST. So now to move forward to the key amendments relating to income tax, as I really take a minute to fix my camera as well, right? So members can please let me know if my screen is now visible. Is my screen visible to you? So a screen on the Union Budget 2026, is it? Yes. So we have the screen which is fully visible now. So, right. So to talk about the interesting aspects of the Union Budget, let me start with the income tax amendments and then talk to you about some other general macroeconomic aspects that have been also happening around. So to kickstart with the income tax amendments, the amendments of the Income Tax Act 1961. If you really see the history of the amendments that have been had in the finance bill, each of the finance bills, starting from the finance number 2 bill of 2019, which was the election year. So we had the finance bill of 2019, where not much of amendments, but starting from the finance number 2 bill of 2019, wherein we had around 66 amendments. 2020, we had around 102 amendments. 2021, we had around 77 amendments. 22, we had around 82 amendments, and 23 at the very highest of around 120 amendments. 24 with 85 and 84 in 2025. So on an average, we have been having around say 88 amendments on an average in each of the finance bills in respect of the Income Tax Act 1961. So now the question to the audience, to the members over here is, how many amendments have been there in the Finance Bill 2026? A very quick guess on the number of amendments which has been there with respect to the Income Tax Act 1961 in the Finance Bill 2026. So here we have some answers to say, right? 75. Okay. Any other guesses? Any other guesses of how many amendments? Right. So we have a good answer, great answer, a best answer here as well. So talking about two numbers. So I think the answer was the question was only one. How many amendments in the Finance Bill 2026? And we have Ganeshamurthy sir. Thank you so much, sir. We have two numbers of 23 and 96. Let us just check on what is that all about. Exactly right, sir. Thank you so much, sir. Ganeshamurthy sir. We have had 23 amendments in the Finance Bill 2026, talking or very specific to the Income Tax Act 1961. Why only very few amendments relevant to Income Tax Act 1961? The reason comes out of Act number 30 of 2025. During the year 2025, there was a new act which was passed by the Indian Parliament, received the assent of the President of India, and the Act of 2025 is called the Income Tax Act 2025. This extends to the whole of India, and save as otherwise provided in the Act, it shall come into force from the 1st of April 2026. This Act of 2025, which is called as very commonly and colloquially called as the 2025 Act, that is Income Tax Act 2025, comes into effect from the 1st of April 2026, and therefore number of amendments relevant to the Income Tax Act 1961 have been only 23. So is it only those number of amendments? If you look at the Income Tax Act 2025, it's a comprehensive rewrite of the entire Income Tax Act 1961, but with the substance of the Income Tax Act 1961 being retained entirely, an act of 536 sections with 16 schedules coming into effect from the 1st of April 2026, which completely replaces the existing Income Tax Act 1961, having 87 amendments through the Finance Bill 2026. So Ganeshamurthy sir, I will definitely check back on how and why there have been 96 amendments that have been taken into account in your counting. But as far as we could check into account, we have Selva Sundari ma'am who said that 78 amendments have been made. So as I could reflect on, there have been around 87 amendments which have been made in the Income Tax Act 2025. In the Income Tax Act 2025 through the Finance Bill 2026. The rules and forms in respect of the Income Tax Act 2025, as I could see, is yet to be notified, and some transition challenges would definitely be there as we move forward towards the implementation of the new Income Tax Act. Right from the very first beginning of the year, the payment of TDS, the filing of TDS returns all gets kickstarted during the financial year itself. So what is going to be the completely substance of the changes? So talking about the tax rates, the Finance Act has had, or the Finance Bill per se, has limited significance when it comes to the GST law, but continues to have the same amount of significance when it comes to the Income Tax Act. So the tax rate for the financial year 25-26 has already been pronounced by the Finance Act of 2025. And now when we refer to the Finance Bill of 2026, it speaks about Income Tax Act, income tax under the Act 30 of 2025, which is the new Income Tax Act, subject to provisions of subsections 2, 3, 4, and 5 for the tax year. So the tax rates are provided in Part 1-B of the first schedule. When I have to compare the nomenclatures used in the 61 Act with the 2025 Act, the first line is the 2025 Act and the next is the 61 Act. You could see that the 2025 Act uses the nomenclature of tax year, but whereas hitherto, so far we have been used to the nomenclature of the assessment year. The 1961 uses the nomenclature assessment year, and when we step into the Income Tax Act 2025, with effect from the 1st of April 2026, we will be using the nomenclature as tax year. That is very clearly brought in right from the beginning of the Finance Act also, which very carefully has given in section 2 or in clause 2 of the Finance Bill, which provides for assessment year in reference to the Income Tax Act 1961 and in reference to the Income Tax Act 2025, it has very carefully used the words tax year, and therefore both section 2 and section 3 come into effect from the 1st of April 2026. One with reference to the assessment year, one with reference to the tax year. So for understanding and ease of connect, whether the amendment that I am now going to talk about, will it be in reference to the Income Tax Act 2025 or with respect to the Income Tax Act 1961? I have used two different logos, not the logo given anywhere by the Income Tax Act 25 or the 1961. The logo which in the slide will very clearly tell you whether the legal provision that I am now explaining refers to the 1961 Act or going to talk about the 2025 Act at all. So the first and the foremost important thing which every individual looks forward in the Finance Bill is with reference to whether there has been any change in the income tax slab rates. Let me very simply clarify that there is no change in the income tax rates for the financial year 26-27 than when compared to the financial year 25-26. So quick snapshot of the tax rates which has been available, which is being applicable for the financial year 25-26, which will continue under the new Income Tax Act. Under the new regime, we have up to rupees 4 lakh, the income tax being nil, from 4 lakh to 8 lakh at 5%, from 8 lakh to 12 lakh at 10%, 12 lakhs to 16 lakh at 15%, 16 lakh to 20 lakh at 20%, 20 lakh to 24 lakh at 25%, 24 lakhs and beyond, 20 lakhs to 24 lakhs at 25%, beyond 24 lakhs, it is going to be taxed at 30%. And then surcharge gets applicable at the higher tax rates. Sir, I am talking about the income tax new regime, where I am talking about tax being applicable for income above rupees 4 lakh itself. But very common understanding for each one of us is that under the new regime, income tax is not applicable for income up to rupees 12 lakh. Then how is this scenario supposed to be? We have the concept of rebate under this default tax regime, which is nothing but the new tax regime which we have been using so far. This default tax regime provides for a rebate of up to rupees 60,000, which shall be available for all taxpayers having a total income of up to rupees 12 lakhs. So up to 12 lakhs, the income tax would be 60,000, and in respect of those taxpayers, in respect of those assessees who has income up to rupees 12 lakhs, then entirely the income tax payable is nullified because of the rebate eligible. Under the Income Tax Act 1961, we would commonly refer to this as the Section 87A rebate. So this rebate continues to be applicable even under the new Income Tax Act 2025, and therefore, under the colloquial understanding, up to 12 lakhs, there will not be any tax applicable, but whereas the tax rates are as being shown in the slide. Over to you. One of the important aspects that gets changed for the financial 25-26 and also for all the other upcoming years, that is with reference to the Income Tax Act 1961 and also with reference to the Income Tax Act 2025, as I have put two badges over here, is with respect to the various due date for filing income tax return. Every month from the second half of the year. The first half of the calendar year is from January to June. January, February, March, April, May, June. First 6 months, perfectly okay. But the second 6 months is going to be a continuous set of back-to-back due dates. Starting from the 31st of July, in respect of those taxpayers who do not have any business income, not subjected to audit, so those taxpayers will have to file their income tax return by the 31st of July. If it is a taxpayer not subjected to audit, not subjected to transfer pricing audit, but having a business income, then the income tax return has to be filed by the 31st of August. Earlier, we did not have any due date for 31st of August, but now, because of this segregation, I am sure that it would ease a lot for the professional community and the taxpayer community, bringing in a lot of certainty to say that not having business income, I will file it by 31st of August. Not having business income, I will file it by the 31st of July. Having business income or in respect of a partner in a firm having business income, there as well, it would be the 31st of August. 30th of September, though not mentioned in the presentation and the slide here, is not the due date for filing income tax return, but is the due date for a tax audit case. And this due date gets utmost significance now after this Finance Bill 2026. But whether it is applicable for this financial year or whether it will be applicable only for the forthcoming tax years, we will look into it immediately in the forthcoming slides. 30th September is the due date for tax audit, and thereupon, after the filing of tax audit report by the 30th of September, then the filing of return for an assessee subjected to tax audit and those partners comes into effect from the 31st of October, and those who are subjected to a transfer pricing audit will need to file their income tax return by the 30th of November. So this new entry of 31st of August is there in reference to the financial year 25-26 also, and therefore it is there in the Income Tax Act 1961 and also under the Income Tax Act 2025. This is going to be a welcome amendment proposed, which will ease a lot of aspect for the taxpaying community and the professionals alike. Extended timeline for the filing of a revised return with a condition. Earlier, any person used to keep on filing a revised return until the 31st of March. Now, the time limit for the filing of a revised return got curtailed up to the 31st of December. Now, the Finance Bill proposes that whether it is for the financial year 25-26, that is returns filed under the erstwhile Income Tax Act of 1961 or the future Income Tax Act of 2025, you will be able to file a revised return up to the 31st of March. For the period up to 31st of December, irrespective of the income, there will not be any fee applicable. But for a revised return, which is filed from the 1st of January to the 31st of March, say for example, let us take the financial year 25-26. For this financial year, if the income tax return is filed within the regular due dates, perfect, no problem. If you are filing a revised return, for that revised return can be filed only and only if the original return is filed within the due date. So you are filing a revised return in respect of an original return filed within the due date. Then in such a case, if the revised return is filed before the 31st of December, no late fee. If the revised return is filed during the period from the 1st of January 2027 to the 31st of March 2027, then a fee would be applicable. The fee would be ₹1,000 if the income is less than 5 lakhs. If the income is more than 5 lakhs, then the fee would be ₹5,000. This would be applicable in respect of a revised return. This is different from an updated return, which is as follows. A person has missed to file the return of income within the due date. And then the return of income, if it is filed after the specified period, would be treated as an updated return. A belated return is different and an updated return is different. A person can file a belated return up to the 31st of December. After 31st of December, it becomes an updated return. So for an updated return, it is not just the mere applicability of interest under section 234 ABC. In addition to the tax amount, the tax rate itself, there would be an additional tax. So the slab has been provided as follows. This was the slab that was proposed in the Finance Act of 2025, and therefore the same continues to be in the Income Tax Act of 2025 also. 12 months from the end of the assessment year, in addition to the tax and interest, additional 25% needs to be paid. 12 months to 24 months, additional 50% of the tax plus interest. 24 months to 36 months, on the tax plus interest, additional 60%. On the period from 36 months to 48 months, 70% over and above the tax plus interest that is being calculated. Now, the amendment that is being made, both in the Income Tax Act 1961 and the Income Tax Act 2025, is to say that an updated return can be filed even after a reassessment proceeding has been initiated, provided it is filed within the specified time limit. So where a reassessment, say for example, in a very popular and a colloquial understanding, reassessment taken under section 148, even after the issuance of a notice under section 148, you can file an updated return by paying the additional tax rate. So when you file an updated return in pursuance of a reassessment notice, then in addition to the additional tax rate as has been explained above, there would be a 10% additional tax rate. It shall be increased by a further sum of 10% of the aggregate of tax and interest payable. So plus 10% is also being proposed now in the Finance Bill of 2026. One more beneficial aspect is that updated return earlier could not be filed whenever there was a loss return. Now, when an updated return is filed, giving effect to a reduced loss. Earlier, I filed a loss return for 1 crore. Now I want to file a reduced loss return to the extent of rupees 80 lakhs. Then also I can have the option to file an updated return. This is one of the harsh amendments that has been made or brought into the Income Tax Act 2025. And let me also very clearly clarify, this is not an amendment made in Income Tax Act 1961, and therefore this comes into effect only for the tax year 26-27. to clarify very specifically, in our interpretation, we do not see this amendment being made applicable for the financial year 25-26, for which the tax audit report will be filed by the 30th of September 2026. Non-filing or belated filing of tax audit report attracted penalty to the maximum extent of rupees 1,50,000, and whenever it is the case of penalty, there was the procedure of the officer being satisfied, or the officer is convinced that if there was genuine reasons, then there would not be any applicability of penalty. Now, whatever was subjected to penalty has now been changed as late fee. So therefore, even a single day delay in the filing of a tax audit report will attract a late fee to the extent of 75,000 if the delay is up to 1 month. Delay beyond 1 month would attract a late fee of rupees 1,50,000, an absolute late fee. Not a delay, not a late fee which is calculated on the number of days, say 100 rupees per day, not like that. A flat late fee is being made applicable. This is for the tax year 26-27 and onwards. In respect of the transfer pricing audit report as well, for the delay up to 1 month, the late fee would be at rupees 50,000, and for the delay beyond 1 month, the late fee would be at rupees 1 lakh. Some amendments have been made in the TCS rates for in respect of the tax year 26-27 and onwards. With respect to alcoholic liquor for human consumption, where the current tax rate, it's not current threshold, the current tax rate is current TCS rate is at 1%, proposed is at 2%. The sale of 10-do leaves, the current TCS rate being at 5%, now reduced to 2%. The sale of scrap TCS now at 1% is now getting increased to 2%. Sale of minerals, coal or lignite or iron ore, which was at 1%, being increased to 2%. Remittance under LRS for education or medical treatment being now relaxed from 5% to 2%. And sale of overseas tour package. Earlier, if it was up to 10 lakhs, it was at 5%. And in excess of 10 lakhs, it was at 20%. This was a very big backlash on the entire tour operators. Now it has been made flat at 2%. This would also very much be welcomed by the tour operators at large. Some clarifications with respect to TDS. Whenever it is a supply of manpower, there was a question whether it was treated as work, that is under the erstwhile provisions of section 194C, whether it could be covered under a contract of work. Now, it has been very clearly clarified that TDS shall be deducted only as under the contractor rates, therefore 1% or 2%, that rates shall continue under the Income Tax Act 2025. With respect to nil TDS or lower deduction TDS, the question was always that I need to approach the officer, and the officer, on being satisfied, will grant me the nil or lower deduction TDS. Now it is going to be a completely online process and completely a rule-based mechanism for approving the nil or lower deduction TDS would be applicable. So another difficulty for a person buying property from an NRI, which was under the erstwhile Income Tax Act of 1961, covered under section 195, you always needed a TAN number and you need to file the return only under the normal TDS return. But for us, when we are buying the property from a resident, then you are directly filing a return come payment option was there. Simplified option using the PAN number was available. Now, from the 1st of October, they have proposed this new system under the Income Tax Act 2025, which goes to say that you don't require a TAN number for the making the payment under for making the payment of TDS, even in respect of property purchase from an NRI also. So under the Motor Vehicle Act, when there is an interest being awarded, that interest was taxable under the erstwhile Income Tax Act. Now the new Income Tax Act proposes that it shall be exempted, and therefore no TDS shall also be applicable on those aspects. Under the erstwhile Income Tax Act, under section 43B, whenever an employee, sorry, not under section 43B, whenever an employee contribution is deducted, that has to be remitted within the specified time limits under the proposed under the relevant tax. If it is not paid, then it would attract a disallowance. Now, the new Income Tax Act 2025 has been amended to provide that even if it is paid before the filing of the income tax return, then it shall be allowed as a deduction. Because there was a segregation, there was a distinction made on the employer contribution and the employee contribution. The employee contribution needed to be deposited within the due date of the relevant tax. The employer contribution you could pay it before the due date of filing income tax return. Now, both you can pay before the filing of income tax return and you would still be eligible to claim the deduction. There would not be any disallowance attracted for this scenario. Capital gain on sovereign gold bond redemption. Sovereign gold bond, whenever redeemed, was exempted from capital gain before the amendment proposed to the Finance Bill 2026. Now, the Finance Bill 2026 proposes to say that it shall be eligible only if it is subscribed by a subscriber at the time of original issue, not purchased in the secondary market, and the same subscriber has held it continuously until the redemption on maturity. So, any interim transfers at the secondary market will disentitle the eligibility for capital gain exemption for these sovereign gold bond redemption. So, this is a tax liability that will come in respect of sovereign gold bonds. This is to be very specifically understood. With respect to buyback of shares under the erstwhile 1961 Act, the buyback proceeds in the hands of the individual were treated as dividend, and the cost of acquisition was allowed as a capital loss. Both could not be set off. There was always a problem. Now, this is being brought aligned under the capital gain itself. Now, the consideration received on the buyback of shares shall be chargeable to tax under the head capital gains. The effective tax rate being for individual promoters at 30%, which is including the tax payable at the applicable rates, together with an additional tax which is being made applicable in respect of share buyback. In respect of promoter companies, the buyback shall be capital gains at the rate of 22%. Restriction in MAT credit carry forward. So, MAT rate of tax has been reduced from 15% to 14%, and a condition has been made to say that the existing MAT credit shall not be eligible under the old tax regime. Under the new regime, it shall be eligible with the restriction that up to 25% of the tax liability, yes, domestic companies can set it off. For foreign companies, the difference between the normal rate and the MAT shall be eligible as MAT credit. So, this is also a change. No new MAT credit will be eligible under the Income Tax Act 2025. Now, this is one more interesting scheme that has been brought in the name of FAST DS 2026, Foreign Assets of Small Taxpayers Disclosure Scheme. So, this is a separate provision in addition to the income tax amendments in the Income Tax Act 1961, Income Tax Act 2025. We have clauses from clause number 114 to clause number 128 talking about this FAST DS scheme. So, this is going to be a one-time scheme where a window of 6 months will be open from the date to be notified for in respect of those individuals who have not disclosed their overseas income or their overseas assets. So, what is going to be the disclosure required and what is going to be the tax impact in respect of those taxpayers, in respect of these individuals? Two categories could be segregated. First of it, those individuals who have never disclosed that foreign income or those foreign assets. So, the scheme itself is FAST DS in respect of small taxpayers, foreign assets in respect of small taxpayers. So, therefore, it says that the total undisclosed value of your foreign income plus your foreign assets, the value of which is less than 1 crore, then you would be eligible to disclose under the scheme where the tax would be at the rate of 30% on the undisclosed assets plus 30% on your undisclosed income plus 100% of the amount which is calculated in clause 1 and clause 2. which simply says that 60% of the undisclosed assets plus 60% of the undisclosed income. No prosecution. No prosecution, but this would be the total amount that needs to be paid. Suppose you have already disclosed the income, you have paid the tax on it, but the assets have not been disclosed. Mind you, you have already paid the tax on the foreign income, but the assets have not been disclosed. Then up to 5 crore of asset value, you could disclose it under this fast DS scheme, subject to the payment of fee, which is up to rupees 1 lakh, to regularize the undisclosed assets. You shall be immune from all the penalty and prosecution that may be applicable. So these have been some of the very important amendments that have been proposed in the Finance Bill of 2026, relevant to the Income Tax Act 1961 and the Income Tax Act 2025. Now, a very quick glimpse, a single slide on how Zentax Trading has been leading the AI-driven innovation in GST litigation. As members might be very well aware that we launched our AI-powered GST reply system at OFA last week, and that has been a very phenomenal reception and welcome by the entire tax-paying community, the tax practitioners, and the professionals at large. Looking at the numbers, we have completed 105 webinars. We are thankful to each one of you with folded hands for being with us across all these 105 webinars, wherein we have had a direct impact on 6,500 plus unique participants and the members coming repeatedly for all the webinars back to back. And our fully free GST notice management has been used by 1,100 plus users and serving almost 28,500 plus GSTIN. So our GST notice management platform is completely free. And this has enabled professionals, taxpayers, not to miss any of the notices. So we launched at OFA on the 30th of January at Delhi at the World Forum of Accountants. And what is this AI-powered reply system? It is a system which does not hallucinate, backed by authenticated legal provisions, 20,000 plus case laws, built by experience. The expertise of our senior mentor, chief advisor, the collective effort of our entire team together has brought in this India's first AI-powered GST reply system, which does not hallucinate, backed by legal provisions, not just technology, built by experience. And along with our fully free GST notice management, try out very soon, very quickly, sign up today at gst.zentaxclinic.com. If you have any difficulty, do get in touch with us. Our contact numbers are here on the screen. So any of the key aspects relevant to the union budget, income tax, GST, or in relation to Zentax Clinic fully free GST notice management platform, or in relation to our AI-powered GST reply system, please do get in touch with us. We are very happy to connect one-to-one for a live demo and to take things forward. So you can also pass in your email ID, contact numbers in the chat box now, so that we will be able to immediately get in touch with you. So these have been some of the very crucial aspects taken into account for the from the union budget. The reception today even has been very phenomenal, So we thank each one of you. There's a view that updated can be revised, right? But I have not observed, right, sir? Some clarifications will come as the finance bill comes into a finance act. Thank each one of you for your enthusiastic participation, active participations across our last 105 webinars. We look forward for your participation at our next upcoming session, which is going to be a very interesting webinar, and all the other upcoming webinars also. Thank you so much, everyone. Keep connected. Thank you, everyone.